Okay, so now we'll start with deferred taxation, which is covered by IAS 12, income tax basically. The large part of the focus of income tax is on deferred taxation. So whenever we talk about income tax, we have two things. One is current tax, then the other one is deferred tax. The deferred tax can be a deferred tax liability, in which case it is an expense, or it can be a deferred tax asset, in which case it is a benefit. Now, the sum of your current tax and deferred tax, these put together is what we call as tax expense. Now, you have to be careful in the examination as to what is the question about. Is it about current tax? Is it about deferred tax? Or is it about tax expense? The moment you see tax expense, you have to calculate both the current tax as well as the deferred tax. Okay. And if it is asking only about deferred tax, then you have to just calculate the deferred tax portion and you have to solve the question. Okay. So current tax is nothing but tax payable based on prevailing tax laws and rates. Whereas deferred tax arises because there is a difference in or difference between accounting income and taxable income. Because there is a difference between accounting income and taxable income, that is when a deferred tax question arises. Okay. Now, when you have deferred tax expense, the question of deferred tax expense, that yes, there is a deferred tax asset or a deferred tax liability. One simple principle for us to understand whether it is an asset or a liability, you just need to understand how much are you paying currently and what will happen in the future. This is the framework. Okay. Once you understand this framework, if at all you are stuck in the examination, it becomes easy for you to compute those relevant liability and asset. So in case of a liability, let me ask you, if you know how much, let's say how much you can recall. In case of liability, do we have lesser tax liability now or less tax liability in the future?
So I can't understand the question.
So when I say there is a deferred tax liability, if at all there is a deferred tax liability, the question is, in case of deferred tax liability, do you have to pay more tax now or do you have to pay more tax in the future?
In the future, sir.
So in case of deferred tax liability, now you will pay less tax. In the future, you will pay more tax. Exactly opposite happens in case of asset. Now you will pay more tax. In the future, you will pay less tax. This is the framework for us to remember whether it will be a deferred tax liability or a deferred tax asset. Now, this difference between accounting income and taxable income can be temporary and can be permanent. If it is a permanent difference, there is no deferred tax income. If it is a temporary difference, then you can have either a deferred tax liability or a deferred tax asset. But in case of permanent difference, there is no deferred tax impact. You do not, or you are not required to calculate deferred taxation. Now, permanent differences are, for example, let us say there is a penalty expense. Penalty expense, income tax law says we do not allow penalty expense as deduction. So something which is not allowed as deduction creates a permanent difference. Or there could be another situation where the income is exempt. If the income is exempt, even in that case, you do not create a deferred tax asset or a deferred tax liability. So those differences which do not reverse. So differences which do not reverse in future. For example, exempt income. Exempt income will never be taken for calculation of income tax. Exempt income will never be taken for calculation of income tax. So if it is an exempt income, then there is no deferred tax impact. Similarly, if there is an expense which is never allowed, then also it is a permanent difference, no taxation, no deferred tax impact. But if it is a temporary difference, this is differences arising in 1 year and reversing in future years. The best example or the most widely used example is depreciation. Depreciation, there may be a difference. For example, 10,000 is the cost. For accounting purpose, you are using SLM 5 years. So 10,000 divided by 5, 2,000. 2,000, 2,000, 2,000, 2,000. 1, 2, 3, 4, 5. Okay. And let us say for tax purpose, it is SLM 4 years. This is SLM 5 years. For tax purpose, SLM 4 years. So 10,000 divided by 4, 2,500, 2,500, 2,500, 2,500, and last year it will be 0. So 2,000 minus 2,500, 500 is the difference. And in the last year, 2,000 is the difference. So what happens is every year 500, 500, 500 got accumulated, 2,000 got accumulated, and at the end, entire 2,000 got reversed. So this is called temporary difference, where the differences arise in one period and they, they reverse in the subsequent period. That is what is called the deferred tax impact. Now, once you have identified that there is a deferred tax impact, what we need to understand is how to calculate deferred tax impact. So, first step, identify the difference. Second, check whether temporary or not. For temporary difference, check whether it will be a liability or asset. Okay. And then you calculate the deferred tax. Now, the way we will calculate deferred tax for the purpose of IAS 12 is take the carrying amount as per books, take the tax base. Take the carrying amount as per books, take the tax base. For example, in year 1, 10,000 minus 2,000, carrying amount is 8,000. Tax base, 10,000 minus 7,500, it is, 10,000 minus 2,500, it is 7,500. So take the carrying amount as per books, take the tax base, then you calculate the difference. And based on the difference, you will identify whether it is a deferred tax asset or a liability. Now, the way to do this, or the way to remember this, is whenever I have been teaching in the class and all of that, I've said, take tax base if it is an asset. Take the tax base of the asset minus carrying amount. So, for asset, always take the tax base minus carrying amount. If it is a negative number, it becomes a deferred tax liability. So, DTL would be, let us say 30% is tax. DTL would be 500 into 30%, which is 150. So that is how you calculate deferred tax liability. Now, in year 2, carrying amount is 6,000, 5,000. Difference is 1,000. Deferred tax liability balance is 300. In year 3, 4,000, 2,500. Difference is 1,500. DTL is 450. Year 4, carrying amount is 2,000. Here it is 0. Bad difference is minus 2,000. DTL is 600. Year 5, carrying amount is 0. Here also it is 0. No difference. The balance becomes 0. So here what has happened is, in year 1, deferred tax expense is 150. Year 2, it is 300. So I'll put it in the negative number. Year 2, it is this minus this 150, 150, 150. And in the 5th year, the entire deferred tax balance is reversed. So you have DTL for 4 years. In the 5th year, DTL becomes 0. You reverse the deferred tax liability amount. Right. Now, if you come back and check here, if you see, you are getting more depreciation in tax. When you get more depreciation in tax, you pay less tax now and more tax in the future. And that is how you calculate deferred tax liability. So for assets, just remember tax base minus carrying amount. Always do tax base minus accounting. If the number is negative, it is a DTL. If the number is positive, it is a DTA. Any question?
So the DTL you calculate for this second and third year is an accumulated DTL.
This is the accumulated balance. Every year expense is 150.
Yes.
And last year everything will be reversed because it is no longer needed.
Yes.
Sorry, sir. How it became 6,000, 4,000, 2,000? Like year one, it was 8,000. Then it became 6,000.
So here is the reduction.
Oh, okay.
Every year 2,000 of depreciation.
Okay. Got it. Thanks.
8, 6, 4.
Thank you.
Now, the way we book, so in, as I told you, tax expense is current tax plus or minus deferred tax. So if it is a creation of DTL or reversal of DTA, it is an expense. If it is creation of DTA or reversal of DTL is a benefit. So for example, if current tax based on the tax provision is 1,000, deferred tax is 150 as we have calculated, tax expense is 1,000 plus 150, 1,150. So for this you will say debit income tax expense current 1,000, debit income tax expense deferred 150, credit income tax payable 1,000, and credit DTL which is created 150. Right. So that is how you calculate the deferred tax position. So the thing you have to remember is do tax minus carrying value. Okay. Do tax minus carrying value. If it is a negative number, if the tax base is greater, or the other way to remember is tax base is greater, then this will get DTL. If carrying amount is greater, it will create a DTA. So let's take one example. Tracy purchased an item of property, plant and equipment of 1st of January for 5 million. It was estimated that it had a useful economic life of 5 years, but according to tax authority, it had a 50% tax allowance in first year and 20% reducing balance thereafter. Okay. So first year it is 50%. After that, whatever is the carrying amount based on that 20%. Tracy made an accounting profit of 2 million for the year, which is expected to continue for the next 2 years. Income tax rate is 20%. Okay. So now here we are required to calculate the tax profit for the 3 years. So I'll just do for 2 years. That should be more than sufficient. What is the tax profit after tax for the, for 2 years? That is what we will be calculating. Okay. So here, what we need to do is accounting. Cost is 5 million. Useful life is 5. So depreciation is 5 million divided by 5, 1 million each year. So year 1, 1 million. Carrying amount is 5 million minus 1 million. Year 2, depreciation is again 1 million. Carrying amount is 4 million minus 1 million, 3 million. Okay. For tax, cost is 5 million. Year 1 depreciation is 50%. Carrying amount is this minus 250. Then year 2, 20% of this. So 50,000. Carrying amount is 2 million. Okay. Now, if I calculate for year 3 also, 1 million. Carrying amount is 3 million minus 1 million. Here year 3 will be this into 20%. Carrying amount is 2 million minus this 160. So if you see the difference, what did I say? For asset you do tax minus accounting. So negative here, and here also it is negative. So it will result in DTL. Okay. So income tax rate, if it is 20%, 150 into 20%, 300,000, 200,000, 80,000 on a cumulative basis. Please remember, this is on a cumulative basis and not for the year. This DTL is the cumulative. So expense, first year expense is 300,000. Second year is 300 minus 200 if you do. Sorry, 200 minus 300 if you do, you get 100,000. So the liability is being reversed. First year we created liability. Now the liability is being reversed. So here accordingly here also the liability is being reversed. So here it is an expense. When there is a reversal of liability, it is a benefit. Okay. So that is how we calculate the deferred tax liability component. Okay. So just to quickly remind again, tax base minus accounting base, whatever is the difference, that difference will multiply with the tax rate to get the DTL position. If it's a negative number, it's a DTL. If it's a positive number, it's a DTA. Okay. And accordingly, we'll calculate the amount of deferred taxation. And be very careful whether the question has asked you to calculate the current tax or the deferred tax or the tax expense. So that is about deferred taxation. Now moving on to IFRS 15, this is revenue. Okay. Now coming to IFRS 15, which is on revenue, this is revenue from contract with customers. Again, a very simple standard, not very complicated, but we need to understand how do we calculate and recognize revenue. So basically it talks about a 5-step process. 1, 2, 3, 4, 5-step process. In the 5-step process, first step is identify the contract. Identify the contract, then identify the performance obligations. So what are the performance obligations? Performance obligations are nothing but promises. Whether to deliver goods, deliver services, provide services, construct a building, whatever it is. What is promised by the supplier to the customer? That is the second step. The first one, identify the contract. Second one, identify the performance obligation. Then transaction price. Now, transaction price means what is the price that has been agreed between the supplier and the customer that has to be determined. Then allocate the transaction price to performance obligation, and last step is recognize revenue as performance obligation are satisfied. Now here, this is the 5-step process. Now very critical part of this is identify the performance obligation. Say for example, in the performance obligation, there are two components. One, delivery of goods. Second, installation of the goods. For example, air conditioner. Air conditioner will be delivered and air conditioner will be installed. Okay, there are two performance obligations which are separate, and we are charged a lump sum amount for that. So what the standard says is, you identify what is the transaction price, means what is the amount payable. Then, if there are two performance obligations, allocate the transaction price to those two performance obligations. So, for example, if it is delivery of AC and installation AC. Delivery of AC and installation of AC on a standalone basis. If you don't want delivery, or if you don't want installation, the AC cost, let us say 25,000. Installation cost, let us say 2,500. Okay, but combined transaction price, because you have taken both the services together, it is 21%. Oh, no, not 21, 26,000. Combined transaction price is 26,000. Now here you should not do that. 25,000 is for AC and 1,000 is for installation. No. What the standard says is identify what are the two promises. One promise is I will deliver the AC. Second promise is I will install the AC. Now, what is the standard price for doing those promises or fulfilling those promises? 25,000, 2,500. What the standard says is whatever 26,000 you have collected. So if you do the combined price, it is 27,500. So the standard says 25,000 divided by 27,500 into 26,000. 23,636 is for delivery, and 2,500 divided by 27,500 into 26,000. 2,363 is towards installation. Okay, so this is how you should allocate the transaction price, and you should recognize revenue. Identify the performance obligation, allocate the performance obligation to the, allocate the transaction price to the performance obligation. Once you deliver the AC, recognize the revenue of 23,636. Once you install the AC, recognize the revenue of 2,366. Okay, so that is a simple, standalone way of identifying or recognizing revenue. Now, when we say identifying the contract, there has to be a contract. Contract can be written, verbal, oral, implied, whatever it is. There must be a contract. When we say contract, both the parties are obliged to perform their respective part. In the contract itself, you must be able to identify what is the transaction price, how much is the amount payable by the customer to the supplier. You must be able to identify what are the various performance obligation. And when you have performance obligation, each performance obligation you should be distinct. Okay, if for example the contract is installation of centralized AC. Now, when you say installation of centralized air conditioning system, their delivery and installation is a single package. So then that becomes a single performance obligation. Then you have to identify the transaction price as per the contract, and that price must be allocated, and revenue must be recognized as the performance obligation gets satisfied. Now, special consideration in the transaction price. There could be variable consideration. There could be financing component. There could be refunds. Okay, so there could be variable consideration. There could be financing component. There could be refunds or rebates. Okay, what do you mean by variable consideration? The customer says, if you complete the work in 6 months, will pay 5% extra. So this is a variable consideration. What are we saying? We are saying that if you complete the work within 6 months time, we'll pay 5% extra. Now, this 5% extra, whatever is paid, that should be recognized when you feel that yes, the work could be completed and the amount would be receivable. Okay. Then there is financing component. What is this financing component? Generally, if it is a credit period beyond normal terms. Okay, credit period beyond normal terms. For example, cash price is 9,000. Pay after 1 year, the price is 10,000. Cash price is 9,000. Today, if you buy, you can buy at 9,000. But if you say, I need 1 year credit period, the entity charges 10,000. So what the standard says is, this 10,000 minus 9,000, this 1,000 is financing element, and it should not be recognized as revenue. Okay, it should not be recognized as revenue. The financing element should be separately recognized as finance income, and revenue should be restricted to the cash price, which is 9,000. So whenever there is a significant financing component in the contract, then in that case, you should recognize the financing element separately as finance income, and cash price should be the price at which you will recognize the revenue. Then refund or rebates or discounts. Okay. Now sometimes discounts may be payable to the customer, or refunds may be given to the customer. Discounts also should be allocated to the performance obligation based on their standalone prices. Based on the standalone prices, you have to allocate the discounts given to the customer. Then the standard also says that if discount pertains to one or more than one performance obligation, discount should be allocated to those performance obligation only. Meaning to say, if there are 5 performance obligation or 5 items to be delivered, and the discount is related to only one item, if that can be identified, then you should allocate the discount to that specific single item only. You should not allocate the discount to all the items. Then there is a concept of performance obligation satisfied over a period of time and performance obligation satisfied at a point in time. Now, over a period of time means, for example, telecom services. It is not a single delivery point. You use the telecom services over a period based on number of months, or let us say consultancy services, teaching services. These are services which are provided over a period of time. And if it is provided over a period of time, generally you will allocate on time proportion basis, unless any other method you find it to be better. Okay, so unless any other method is better, you will allocate the transaction price on time proportion basis. For example, consultancy services for 2 years. So you will recognize revenue on a monthly basis. If it is a point in time, for example, delivery of goods. If it's a point in time, for example, delivery of goods, the moment the goods are delivered, you will recognize the revenue. Or the moment the control is transferred to the customer, you will recognize revenue. There are specific conditions involved here, but I'm not going into detail because it's a revision session. The concept you have to keep in mind is whether the promise is satisfied at a point in time or over a period of time. If it is satisfied at a point in time, then recognize revenue when the when the condition is satisfied. If it is over a period of time, generally you will recognize on a time proportion basis. Then, if you are principal and if there is an agent will recognize only commission as revenue. Principal will recognize sale value as revenue. So if the agent is getting a commission, an agent is collecting the amount on behalf of the principal, even then the revenue for the purpose of the agent is only the commission, and for the principal it is the total amount. Then sometimes you have repurchase arrangements. So let us say I sell inventory.
Sir?
Yes.
Also, the principal can recognize revenue only when the sale is made by the agents.
Correct. Only when the control is transferred. The ultimate test is performance obligation being satisfied. That happens generally when the control is transferred.
Yes, sir.
Okay. I sold inventory 1000 units. Price is 100 per unit. Amount is 1000 into 100. Then I have a repurchase agreement for the same 1000 units at 110 at so and so amount. Okay, so when I sell inventory, I get money, and I'm saying after 3 months, I will buy back the inventory, the same inventory, by paying 110. Now, these kind of arrangements are done generally to, sometimes the companies want to inflate revenues, sometimes the companies want to manage the liquidity position. In essence, I'm saying you keep my product for 3 months, I'll take back the product after 3 months and I'll pay you 1 lakh. So here, what the standard says is, if there is a repurchase arrangement or repurchase agreement, and then there is, the contract, if you look at the contract, you can make out that control is not transferred. Risk and reward is still with the seller. Because when you sell the inventory at 100 and when you buy back at 110, or if you have agreed to buy back at 110, assume for a moment on that date market price is 50 or 60. The seller is bearing the risk of inventory loss. So, because the risk and rewards are not transferred and you are buying back the same inventory, it is in essence refinancing or a financing arrangement. So, this should not be recognized as revenue. You should say that the company has borrowed 100,000 of loan and the company has repaid 110,000 along with interest. So, this should be treated as a financial liability and you should not be recognizing revenue for this. Okay. So this is one specific aspect of revenue recognition, which has to do with your contract related accounting, construction contract related aspects. So let's have a look at this question. Rattan commenced a contract to build an asset for a customer in the year ended 30th September of year 4. So they have entered into a contract. The contract price was agreed at 1.5 million. Now please remember, these contracts and all, these are generally over a period of time. Okay. The contract price was agreed at 1.5 million and the total expected cost of the contract is 800,000. Rattan will satisfy the performance obligation over a period of time. Generally, when you're doing construction, it is not at a point of time, but over a period of time. The following figures were correctly recognized in the profit and loss for the year, for the account for the year ended 30th September. Revenue 450, cost of sales 240, profit. Okay, so that is what is recognized. Now, the following figures are also relevant in this context. Work certified till date in year 4 is 450. In year 5, work certified is 1050. Rattan recognizes progress on the basis of work certified compared to contract price. What should Rattan include in its statement of P&L for 30th September of year 5 as revenue in respect of the contract? Now, what you need to understand is, whenever there is a construction contract, it is a performance obligation satisfied over a period of time and revenue is recognized based on work completed. Now you can use input method or output method. Input method means total cost incurred divided by expected total cost. Output method means total work certified or work completed by total revenue. Okay, so total work certified by total revenue. Based on that, you will recognize revenue. Now here they are saying that they will recognize revenue based on what? They will recognize revenue based on work certified. So in first year, work certified is 450. Year 4, work certified 450. Total price 1500. Percentage complete is 450 divided by 1500, which is 30%. So revenue is 1500 into 30%, which is 450. Now, in examination, you can consider that yes, 450 if the work is certified, and because it is based on work certified or work completed, 450 can be recognized as revenue directly. There is no need to calculate. Now, the question is, how much should be the revenue that should be included in the P&L for year 5? Now, please remember, 1050 is the total work certified. So, in year 5, work certified is 1050, total price is 1500, percentage completion is 70%, cumulative revenue should be 1050. So, one thing what we can conclude is, if it is based on work certified, the amount of work certified can be considered to be your revenue. But this is cumulative. Revenue to be recognized should be 1050 minus 450, 600 for the second period. So for 30th September, revenue to be recognized is 600. See, a simple 2-minute calculation and you can score, 2 out of 2 marks in the question. Let's look at this one. Malik is a construction business recognizing progress based on work certified as a proportion of total contract value. Malik will satisfy the performance obligation over a period of time. The following information relates to one of its long-term contracts as of 31st May, which is the year end. Contract price, cost incurred, estimated cost to complete, invoice to customer, work certified till date. In the year 31st March of year 3, Malik had recognized revenue of 60,000. What should they have recognized as, what profit should appear in Malik's statement of profit or loss as at 31st May of year 4 in respect of this contract? So, year 3, year 4. Year 3, they have said they have recognized a revenue of 60,000 and profit of 15,000. Which means cost is 50,000. In year 4, work certified till date is 180. Work certified till date is 180. You have already recognized 60. So 120 is what you should recognize here. Cost Cost incurred till date is 135. So you have already recognized 50. So 135,000 minus 50,000, 85,000. So the profit to be recognized in this year is 120 minus 85, 35,000. Whatever is invoiced to the customer is not relevant from the point of view of revenue accounting. Revenue recognition should be based on the profit that the work that has been completed by the entity and the work that has been certified. Okay, so in examination, don't think that the revenue completed or the billed amount to the customer is relevant. The billed amount to the customer is not relevant in case of your, what do you call, revenue recognition. Now, where do we use the billed amount? Billed amount is used, it will be useful in the case of your calculating contract asset and contract liability. Okay, so whenever there is the question relates to contract asset or contract liability, in that case, the billed amount to the customer is relevant.
So here directly we can calculate this. We don't want to calculate percentage of completion.
No, you can calculate the percentage of completion. Again, the final output will be the same.
Same. Yes.
See, if it is a working, if it is a constructive response question, then you have to calculate.
Yes, sir.
Okay. Then in the financial statement, what I was referring to, contract asset or contract liability. So Sagar has entered into a long-term contract to build an asset for a customer. Sugar will satisfy the performance obligation over time and has measured the progress towards satisfying at 45%. Price is 8 million. Sagar has spent 4.5 million to date, but the estimate cost to complete is 5.5 million. To date, Heaver has paid 3 million. Now here also we need to understand, we have to check the outcome of contract. See, in the previous case, I have not checked because the outcome of the contract is profit. If the outcome of contract is loss, you must recognize the full loss. Meaning to say, if revenue is less than cost incurred plus expected, then we say outcome is a loss. The entire loss has to be recognized. Now here, price of contract is 8 million. Amount spent already is 4.5 million. Amount to spend is 5.5 million. So 5.5 plus 4.5, it is 10 million. So loss expected is 8 minus 10, 2 million. This loss expected to be recognized fully. So whenever the outcome of the contract is a loss, you will have to recognize the amount fully. Now here the question is, what is the net liability that should be recorded in Sugar's statement of financial position? Now here, revenue is how much? Revenue to be recognized is 45%. So 8 million, 45%. The revenue to be recognized is 8 into 45%, which is 3.6 million. And they have spent 4.5 million till date. Cost 4.5 million. Okay, so how much will be the loss? Loss will be 0.9, but we have to make a provision of, or we have to recognize a loss of 2 million. So provision for loss 1.1. This makes it 3.6 minus 4.5 minus 1.1. 2 million is the loss. Now the question is, what is the net liability that should be recognized? So revenue, amount billed. So they have not given amount billed. We can assume that revenue itself is the amount billed, 3.6. Less amount received, 3. So we billed 3.6, we have received 3. So net balance from the customer is 3.6 minus 3.6. And we have a provision for loss, which is minus 2. So net liability to be recognized is -2 plus 0.6, which is -1.4. Okay. So generally, when the question is about asset or liability, you have to see amount billed minus amount received. If amount billed is greater than the amount received, then it is an asset. If amount billed is less than the amount received, then it is a contract liability. Okay. So yes.
So, but provision for loss is 1.1 in the current year. It's 1.1 is the liability, no, sir. Other 2 year.
Sorry. 1.5. So that makes it 0.5. Okay. So this broadly covers the aspects that you have to keep in mind for as far as revenue accounting is concerned. IFRS 15. Okay. So questions can be around, one aspect is the 5-step process, and the second aspect is the contract, recognition. How much of revenue should be recognized? How much of profit or loss should be recognized? And please remember, not to take the cumulative figure like in the questions we saw. You have to take the figure for the year depending on what is the question that has been asked. Any other doubt you had in the IFRS 15 thing, Bala?
No, sir. IFRS 15. It's clear.
Clear, no? Yeah.
Yes.
Okay.
So, but I have the other doubts while doing the revisions.
Like which doubts?
So, one, I want to clarify with you, sir, is that from chapters 1 to 10, sir, there are many areas where they're repeatedly using the word fair value of asset. It's in many areas there is.
Correct.
So it's like how we can make a revision of this, sir. It's like continuous revision is enough, sir, or do we need to make separate note of it?
What do you want to revise in fair value? See, fair value will be given to you in the question.
Yes, sir. But many areas it's like fair value less cost to sell, and sometimes it's like only fair value. It's differing from for.
So, for example, okay, I got your point. For example, when you go to IAS 16, it says revaluation model, that is, there is only fair value. There is nothing called cost to sell.
Yes, sir.
Correct. Then if you go to IAS 40, there also it is fair value.
Yes, yes, investment property. Yes, sir.
Investment property. But then, if let us say you go to impairment, it says fair value less cost to sell. Now,
cost to sell.
So the logic that you need to keep in mind is, if I am recognizing, see, if my intention is to calculate what will I realize if I sell. Okay, when I'm doing a revaluation model, I'm not calculating what will I get when I sell. But when I'm doing impairment, I'm calculating one is value in recoverable amount. So when I say recoverable amount, it is normally the fair value minus whatever is the cost to sell. Okay. Same way, if you go to agriculture, there also it is fair value, because I'm trying to figure out for my inventory item, that is agriculture, what will I get if I sell? So fair value minus cost to sell. Inventory, you are again net realizable value, selling value minus cost to sell and complete. Okay. So if at all you are finding, these are 7-8 places where fair value is used extensively. Okay. So just for a quick recap for you, IAS 16, IAS 40, there we use fair value only. IFRS 9 also we use fair value only. But wherever you're using a term like net realizable value for impairment of assets, for non-current assets held for sale, held for sale or disposal, or for agricultural assets where agriculture activity where we are saying, okay, what is the realizable value? In all of those cases, we will reduce the cost to sell. Does that make sense? Bala, are you there?
Sir, sorry, sir. My internet got disconnected, sir.
I gave us such a nice long lecture in
Sir, sorry, sir.
No worries. I'll again repeat it. Okay. So there are two aspects. One is where you are trying to determine how much will you get when you sell. Inventories, net realizable value. What is the value that we will get when we sell? Okay. Same way when it comes to non-current assets which are held for sale. How much value will I get if I sell? Okay. Same way impairment of asset, recoverable amount. How much amount will I get when I sell? So there the intention is calculating the final sale value where we reduce the cost to sell. Whereas when you're doing revaluation model, intention is not to calculate the amount. If our intention is not to sell there, okay, our intention is, if I hold it, what is the value for it? See, when I'm saying impairment of asset, if it is a loss kind of situation, it arises when I sell. So there we are reducing the cost to sell. So IAS 16, IAS 40, then IFRS 9. In all these cases, it is fair value. Okay. Whereas in other cases like impairment, non-current assets held for sale, then your inventory and all, there we reduce the cost to complete and cost to sell.
Yes, sir. Yes, sir. That's my doubt.
So don't be overly concerned. I'll also do one thing. Right away, I will share you one. This is the notes. Okay. So I'll share one set of notes for you. Don't you can start looking at them for chapters where you are confused. That will actually
Yes, sir.
help you revise. That these are really good notes for quick revision.
Okay, sir.
But for important chapters like IFRS 15, 16 and all, at least once go through the text.
Yes, sir.
Okay, so just don't think that, okay, we'll only do this and we'll clear. That doesn't happen. So I'm sharing with you notes that will
Sir, also, like when doing impairment chapter revision, sir, I suddenly got confused between like impairment and revaluation loss, sir. It's actually when we do cost model, we use the term, we use impairment, and revaluation model, it's revaluation loss. That's it, no, sir.
No, in revaluation model also there may be impairment, but generally because you are doing fair valuation, there is less likelihood of being those assets being impaired.
Okay, sir. So revaluation model, it's like continuous from year by year, we have to revalue. Or like
Year by year you have to revalue, and okay, so the confusion that has come is impairment testing is done when I believe that there is a loss. See, revaluation can be a gain also.
Yes, sir.
But when it comes to impairment, 100% there has to be a loss scenario.
Okay, sir. Okay. So at any point of time, when I feel there's complete depletion in the value, so I impair the assets.
Correct.
Yes, sir.
Okay.
Yes, sir. Sir, also one more thing, sir. Like like in the 20-mark questions, sir, they may combine all the all the chapters, sir. Like I'm confused. Like
No. So one thing is this is a typical student syndrome, fear syndrome. I also used to go through the same thing, that they will create the most difficult question possible on the planet.
yes,
Okay.
sir. Yes.
It doesn't happen that way. You cannot combine. So okay, do one thing. No, and just okay. Let me just put it this way. If you have to prepare a balance sheet, right? For a 20-mark question, they can give you 5 or 6 adjustments, not more than that. Okay. In those 5 or 6 adjustments also, one will be necessarily property, plant and equipment. One will be sometime inventory. Sometimes there may be impairment, something related to that. So at the most, they will give you 3 or 4 standards where you will be tested for adjustments. Apart from that, they cannot test you 20 adjustment in a 20-mark question. No?
Yes, sir.
Okay. So for a 20-mark question, or let me just open this exam kit only. Let us just go down slightly. It's a valid question, and I also suggest that you do one use the ACCA Practice Platform and do one practice test. Even
Yes,
if
sir.
it is you are saying my revision is not fully complete, there is some doubt. Even if it is left over, just do one so that you get an idea of what is happening. Then 2 days before the exams or 3 days before the exams, you can do it a more thorough attempt for that.
Okay, sir.
Okay. Just a second. So this is a constructed response question. Okay, just for our example, and we have seen similar things. The following is a trial balance extract. They are given the trial balances. Then suspense accounts represents credit for cash receipt for fully subscribed rights issue of share. The terms of shares issue were 1 new share for every 5 share held for 75 cents each. So this kind of adjustment we have already seen. So share amount is received, that we need to correct. Then non-current assets. To reflect a marked increase in property prices, they decide to revalue the lease property and so and so. The director accepted the report and who valued the lease property at 36 million. They have not yet recorded the revaluation. Remaining life of the leasehold property is 8 years at the date of revaluation. They make an annual transfer to retain profits to reflect the realization of revaluation surplus. Revaluation does not give to deferred tax liabilities. Here, revaluation surplus, they will increase the value of the leasehold property, that is right of use asset, and balance amount will be amortized over the remaining useful life. On 1st April, they acquired a fresh item of plant under a lease agreement that had an implicit finance cost of 10%. Lease payments in the trial balance represent initial deposit of 2 million paid on so and so. First annual rental 6 million paid on so and so. Lease agreement further requires annual payments of 6 million at the end of so and so period. So this is the lease related adjustment. Plant is to be depreciated at 20%. No depreciation has yet been charged on any non-current asset. Then the internal audit department discovered a fraud, and so when did they discover? March, year 2. Okay, this pertains to year 1, so much pertains to year 2. Then income tax calculation shows so and so, and investment. Prepare a statement of P&L, prepare a statement of changes in equity. So P&L, OCI, and only equity, not even the balance sheet, 20 marks. So it has tested how many standards? This is not a typical testing. Non-current asset revaluation, 1 test. Lease, 2nd standard. Depreciation is normal. This is fraud related prior period correction, 3rd. Tax calculations and investments had a fair value. So only 5 adjustments were passed.
Yes, sir.
Correct. Okay,
Yes,
so towards the end of our revision, we will be doing a couple of these questions also, so that you get some comfort on how to handle these questions in the examination. We have already done P&L balance sheet related questions, correct?
Yes, sir.
Right. So you would be able to, do it well that way. So don't be scared that, so even here also if you see suspense account, the same question, different question.
Sir, even if they didn't ask balance sheet, can we like roughly prepare the balance sheet for our
Prepare, but time would be consumed.
time? Yes, sir.
So here if you
If
see.
we have time, sir, at last.
Here. So first is related to IFRS 15. Second is related to financial liability. Third is related to property, plant and equipment, investment, and current. That's it. Standard. Just practice 2-3 questions. And yes, there will be cases where you will be struggling at some point of time. You may not be able to get the final answer. That situation may come, but that does not mean that you are not fully prepared for the examination. Sometimes the adjustments can be tricky. Okay.
Yes, sir.
And
We'll make sure for well-known adjustment, we'll prepare the notes and make those adjustments clear, sir.
And more importantly, for for the examination, if you are able to handle the first 2 sections properly,
Yes, sir.
okay, that takes care of a significant portion of the marks.
Yes, sir. Yes.
Yeah. Okay, chalo. Thank you.
Thank you, sir.
Thank you, sir.
Thank you. Thank you.